All right. Yes, Antonio. Yeah, I hit record. Thank you for reminding me. It's happened a few times where people have forgotten, so that's always good to remind me. All right, guys. So we are going to be talking about taxes and fees tonight. So when it comes to your investments, this is often just not discussed. It's totally brushed under the rug. And one of the things that is the biggest impact on someone's portfolio are taxes and fees. So why do we leave this conversation out? I think Wall Street has intentionally done this to deceive investors of big returns, but gross returns, but on a net basis, they have a lot to pocket because the fees go directly to the brokers that provide the investments, the people on Wall Street, all the big hedge fund managers, all those guys are the ones profiting, and they're basically eating your returns. So a lot of these companies have been put under pressure publicly on to reduce these fees. And so you've seen big brokers such as Fidelity, they'll have commercials on, hey, we're going to zero fee expense ratio on this fund or this fund. And that's good, but that's not the whole picture. So tonight you're going to learn about the fees from a total perspective, the taxes from a total perspective. And I hope this gives you guys some insight into really what it's kind of a dog eat dog world of how they do this, but this is going to be really good tonight. So first slide, I want to kind of break it down with a visual. I think this is always very helpful for people that don't understand where these fees are lying. Like, you hear investment fees, you hear expense ratio, you hear all these things thrown out, but a lot of times we just don't know, we don't understand it fully. So I like to look at this as the layers of investing. And I say index investing because this is an index fund specifically, but for the most part, this is going to be the case across all the board across or everything. So brokerage, you're going to start with your brokerage. This is where you're buying your investments through. Some people are buying Robinhood. Some people are using Vanguard, Fidelity. That's who's housing your investments. There are fees at this layer, at this level. Then you go within there and you have to select an account. So IRAs, 401ks, taxable brokerage accounts, all sorts of different accounts, 529s, UPMAs. Then within, you actually have to select your investment. And so some people skip to this step and they just pick an individual stock like P&G, McDonald's, etc. Some people pick a group of funds, which is like an index fund or a mutual fund, slightly different. If you're in like a 401k, you're likely going to only have the option of index and mutual funds. You won't be able to go select individual stocks through a 401k. Now, if you're an IRA or taxable brokerage account, that's a different story, and you can go skip this step and go straight to the stock. However, all of these layers incur some sort of an expense or fee, and so that's what I want to talk about. So the very first one. So now I'm going to have the arrows pointing to which level we're referring to. So brokerage level fees, brokerage service fees, these are usually not huge, but they are a fee nonetheless, and they could eat into your portfolio slowly. A lot of times brokers might charge, a minor fee of $20 for this per year, to give you guys some sort of a background in numbers. So, but if let's say you hold investments of a rather small dollar amount, let's say $1,000. Well, $20 of that 1,000 is fairly substantial as a percentage. And so when you're looking at in fees and stuff in general, you always want to look at the percentage, not necessarily the dollar amount. Because if you have 10,000 in fees, but you have $10 million, that's a pretty small percentage. Whereas if you have $20 of $1,000 investment, that might be a larger, substantial margin. So the broker service fees, a fee charged by the broker that holds your investment account. So the Vanguards, the Fidelities, this is essentially to maintain it. The subscriptions for premium research or data, fees to access trading platforms, or even inactivity fees for infrequent trading or activity in there. So these can always be there. A lot of times, just as a disclaimer, is you can actually get very low fees through a good quality broker. They aren't going to nickel and dime you. There might be something. I know Vanguard has a $20 fee, but you can get it removed. So these are things that you can either adjust your settings for. Like, I know Vanguard does a $20 electronic fee. So if you just tell them to stop mailing them statements and just say, hey, send it to my email. You'll save $20 a year. Doesn't sound like a lot, I know, but these do add up throughout time. And you'll see on a chart here soon of how much these actually do impact you. So I highly advise you guys to figure these out. And I'm going to show you exactly how to figure these out, but go into your portfolio and understand what you're paying to maintain this essentially. So this is the broker service fee. The individual, so you see the arrow drop down one level. So now the brokerage isn't too bad. The account has, some more, right? So this is an individual service fee, and these can vary depending on the broker you're with, of course, and what kind of account you're holding. But typically, this is going to cover features like, let's say, a 401k loan, rolling 401k investments into an IRA. So the rollover feature that a lot of people I recommend, nothing wrong with it, but this is the kind of fees that you might get along with the brokerage, or seeking financial advisory services. So some really well-known brokers will let you call them and pretty much ask for free advice somewhat, but it's not really free at the end of the day. So there is a way for them to pay those salaries that you're talking to on the phone, and that's through the individual service fee within your account, and that might be prorated across the whole board, or divided by a specific amount depending on how many people. But that's a really good thing to take into account and think about those, because I do for my job, I specialize in benefit plans, so I'm looking at these all the time. And one of our procedures is to actually look into the investments, to look into the fees associated. And it scares me every time I look at somebody's portfolio. They have no idea, most likely, because they just see the total balance because it's not hitting their direct bank account. But if they actually looked into what fees we're taking out, there will be thousands of dollars in fees that people don't understand. They see, hey, my balance is at 93,000 and net balance is at 92,000, whatever. It looks the same to me, but really they're losing $1,000 in fees in that example. So something to always be aware of, especially the individual service fee. So this is the bread and butter, the biggest one, that if you can avoid any of these fees, avoid this one. So this is the expense ratio. And so this is down at the index fund level, and I put index fund and stock level. So this is if you own a mutual fund, an index fund. And so 401ks are known to have really high expense ratio with the products they offer. So much that my wife has a 401k that we don't invest in because of how high the fees are. Every single fee in that investment, her 401k plan, is above 1%. And so we opt to just not invest in that. We use other alternatives. We use my 401k, IRA, pension, et cetera, taxable brokerage, because we're staying away from that. And that's how much they mean, even something as small as 1%. But expense ratio is the annual fee that all funds or exchange traded funds, ETFs, charge their shareholders. So when you think of, when you go to investment and you say, hey, I want to do an index fund, I hear you BudgetDog talking a lot about that, the Wealth Dad talking a lot about index funds. Those are typically going to be lower expense ratios naturally because of the core investment that it is, right? The investment of an index fund is a very passive fund. There's not much maintenance from a mutual fund manager to really do. They just kind of set it and forget it. Now, if you look on the other side of things, like ARC or a mutual fund, an actively managed mutual fund by Kathy Wood, there's nothing wrong with it, but you have to understand the expense ratio that you're paying to get that type of fund. The goal is obviously to outpace those index funds with those actively managed mutual funds, but you will have to pay a fee to get that. And so that's what comes with the expense ratio. If you guys hear me talking about that a lot in the Wealth Squad, that is exactly what it is. It is the 0.75 that you're paying over and above the index fund that might be 0%. And when you're talking long-term investment returns, you're typically talking very slim margins. And so 1% can mean a ton in the long. If you have an 11% return versus 10% return, and you beat the market, that's huge. But then you have to account for that 0.75. And now you're at, the net return was what you really need to consider of 10.25. In that example, obviously you beat the market, but again, there's nothing wrong with an actively managed mutual fund, but we have to be aware of what's involved and what you're getting yourself in order to do that and try to beat the market. So this includes 12B1 fees, management fees, plan administration, operating costs, and all other asset-based costs incurred by the fund. This is usually the biggest fund expense eating into your real returns. Like I said, net return versus gross is a lot different. a lot of times people are posting or talking about their gross return. So they'll talk about, hey, I earned, let's say, 25% on this investment. Well, what they're not telling you is the fees that came out, the taxes that came out of that investment, and all that kind of stuff. So the net return is really what you're taking home and pocketing. So that's the most important, the number. Because if I earned, let's say, 12% gross, but I had 3% in fees where I could just invest in an index fund that earned 10%. Well, my net difference is 1% index fund favorable. So this is the average expense ratio for actively managed funds are 0.5 to 1%, which is makes sense. Kathy Wood's ARC fund is 0.75, right in the middle of that. They rarely exceed 2.5%. If you're seeing 2.5%, just write that one off. That I can't make a case for that one. I could probably make a case for 0.5 to 1% in certain scenarios. But passive index funds, the typical ratio is about 0.2 or lower. And most of them are, quite honestly, 0.04, depending on what kind of, index fund that you're in. But if you take nothing away from this presentation, expense ratio, please check what that is when you're investing. Exchange fees. So these are fees that are some funds impose on shareholders if they exchange or transfer to another fund within the same group. So this is just another fund, or sorry, a fee within this level that you need to be paying attention if you're exchanging a bunch of stuff within that same fund group. And then you have purchase fee. So purchase fee is the shareholder fee that some funds charge. And note, I say some funds because not every one of these funds are going to charge it, but to be aware of all of them is always good to know. When investors buy mutual fund shares, this is not the same as, and maybe in addition to, a front end load fee, which I'm going to be talking about in a second. So this is just a straight up purchase fee. These brokers are kind of dirty. So the more quality your broker, the less you're going to have to deal with this kind of stuff. But this is simply just because, hey, I'm going to buy something, and because you're buying from me, you owe me a specific fee. So be aware of that. Transaction fees. So this is one of the more common ones outside of expense ratio I see. But with the new, let's say, Robinhoods and 212 trading, I think it is, they have kind of eliminated these transaction fees. So a lot of people in the past, we had to deal with, if you started investing, let's say 20, 30 years ago, these were a lot more common, the transaction fees. So as you can see here, it's basically each time you place an order to buy or sell, you're charged a specific fee. So they range from $9.95 per trade to over $50 per trade, which is absolutely insanity. If you're investing small amounts, they add up very fast. The amounts deducted from the fund assets, just like the net return versus gross I was referring to. So here's an example of, let's say, a $50 transaction fee on a $5,000 investment. You might see, hey, that's a pretty small amount, kind of like we were talking about the $20 on 1,000, but that's actually a 1% fee, which, again, you'll see in a second what that actually does, because fees either compound for you or against you, just like your investments do. Your investments are, there's compounded growth with time. So do the fee. The fees do the same thing, but in the opposite direction. So you got to be careful with that. Then you have the redemption fee at the same level, index fund stock level. So these are fees that some funds charge when investors redeem or sell the mutual fund shares. The US SEC has limited these redemption fees to about 2% of the sales amount. These are less common, but I have seen them at times. So definitely something to be on the lookout for. And then you have the back end load fees and the front end load fees. And so definitely, I'm thinking from my dad's perspective, and you might hear Dave Ramsey and people like that, maybe the older generation, talk about these because these were more common a while back. But fees paid by investors when selling mutual fund shares, it's expressed as a percentage of the value of the fund shares. A backload end load fee can be a flat fee or gradually decrease over time, usually within 5 to 10 years. These are just things you don't want involved or attached to your investments. If they are, be very wary about investing into that. The front end load fee is a sales charge or commission that an investor pays up front upon purchase of the asset. Sorry, my thing keeps going forward, guys. The percentage paid for the front end load varies among the investment, but typically ranges of like 3.75 to 5.75%. That is absolutely terrifying. Like I said, 1% scares me. So if you're hitting 375 or 575, just run for dear life and just say no to that investment. That's not gonna help you in any way. So those are kind of the portfolio in the investment type fees. Now we have other fees outside in the investment game that people are very accustomed to probably seeing is the management or advisory fee. So that's why I crossed out this visual because it doesn't pertain to the brokerage, the account, the index fund, stock at all. This is actually, let's say you have that guy, you always hear somebody say, hey, my guy takes care of my investments. My girl takes care of my investments. That's where you're dealing with these. So you're going to pay somebody to manage your portfolio. What they're going to charge you is what's called an AUM or asset under management fee. And that's going to be a pretty high percentage. Typically, it's going to be 1%. Pretty much anybody that I've ever seen work with a financial advisor is 1 to 2%, which is a very, very high fee margin. They're also included with any robo advisors. So if you guys have a lot of accounts have robo, I'm trying to think of one of the most common ones I've heard of. Can't think of any off the top of my head, but like they typically charge a lot smaller because it's obviously a robot doing it based on the analytics and probably facts they import into it. But theirs usually range like 0.35 to 0.5. Not horrible, but definitely not something I recommend. So my thought on advisors in general, I think advisors have a role. I think there's good advisors, and I think there's also bad advisors, just like any profession. Some are going to outperform the market and do well for you and help you, but at the same time, a lot of them are in there to get profit, and so they're going to put you in high, high expense ratio mutual funds that are just not going to do the trick. And they're going to also charge you a percentage on top of that. So you could be paying, if you go through a financial advisor, you could be paying not only the fees within the accounts in the index funds, expense ratios, but also the guy or girl that runs the account. So you could be at the end of the day 3-4% before you know it, and be really, really, feed out essentially with a net return of way less than you could have gotten with, creating your own or DIYing it. I do think advisors have a role, like I said. So a lot of people are emotional with the market. So if you are one of those individuals that I don't want to keep track of it, that would be an advisor would be a route for you. Somebody that's like, hey, I don't really feel confident when the market drops 20-30%. I'm prone to sell. Like I know I'm going to sell because I'm going to freak out and try to take my cash. Get an advisor in that point because I don't want you guys to sell when the market drops, but they're kind of like an investment therapist. Think of it like that. I like to talk about financial advisors as kind of like just an investment therapist that's helping you along the way and kind of guiding you and speaking general sense to you when you're not thinking with common sense because the emotions are overriding that through, let's say, market fluctuations. Now, if you do go the advisor route, I recommend you guys ask them how their compensation package is structured because this isn't asking them, hey, how much are you making? What's your salary? So it's not rude, but this will answer the question if they are a true fiduciary that they claim to be. So anybody that you talk to that's a financial advisor is going to say, hey, I'm a fiduciary. That's basically to say, hey, I have my best interest for you and it's not for me. So people can say that all they want. They can sign a million different papers, but let's be honest, it's a dog world and they're not after your best interest. They're after their best interest. Sure, they might help you along the way, but if they're not getting their profit, who really knows, the truth of it? So I always advise somebody that uses a financial advisor to ask that question. I think it's very, very reasonable. If they get offended, I think that's a flag for concern and maybe look to another guy because if I'm going to be honest with you, there's a financial advisor at every single door. So it's not like that guy's probably more special than the next. So find the right one, shop around if you are in that market to use a financial advisor. Just understand that you're going to probably pay 1 to 2%. Nothing wrong with that. Again, just kind of like other things, but it's something to be aware of if you do go that route. So those are the fees. Let's say those are the highlights of the fees that people experience. But now, how do we actually find that? Because that was just very informational and high level. It's like a college course, right? They don't actually help you learn how to actually apply this. So I'm going to help you learn how to apply this. So if we're looking for the investment level fees, so remember back to our first visual, we had the brokerage level, the account level, the investment level, and then the stock, kind of the investment together. And then you had the management and advisory fee as well. So the brokerage and account level, you can find that in your disclosure. So if you guys have let's say open an account through a 401k, just download your 401k disclosure and you're able to search for fees and expenses in there. So that's not what I'm going to walk you through. I'm going to walk you through the actual investment level fees, which are the biggest ones. But if you guys want to look into the first two, which is the individual service level one and the brokerage one, do that. Just download your brokerage disclosure that they provide you with opening the account. That will have everything in there for that. Now, when you get down to selecting your investments, this is a different story. So I'm going to use an easy example, the S&P 500 VFX. This is my favorite investment, FY. So if you are curious about VFX or how to look up fees, all you got to do is do these 3 steps and you will be covered for all of this stuff. So step 1, you're going to Google VFX prospectus. Step 2, you're going to click and open the very first link. Now it might be the second or third link, who knows. Step 3, you're going to search the fees. Just literally do Control F, Control Find, and then just do search and then type in fees. And it's going to take you to this whole entire thing. And so you can see, as you see here, Admiral shares and investor shares, that's just the share class. So basically, if you have more money within, I think it's 10,000 is the mark, you boost from investor shares to Admiral shares. This is with Vanguard. Simply, that's once you have enough money with us, we're going to charge you less. So we're going to bump you up a share class. And that's all that is there. It's the same fee. So like the S&P 500 index fund is actually VFINX. So FINX for investor share class. And then it changes to VFX for Admiral share class, but ultimately the same thing. So as you see here, a lot of the same names that we listed up in the beginning presentation of sales charge, the load fees, the front end and back end load fees, purchase fees, another sales charge load fee. And as you can see, there's none here because I'm using a low cost index fund that typically doesn't have these fees. Redemption fee. Then you have the account service fee. So it's obviously the $20, and I'm going to show you a little more in this one specifically in a second. This is kind of that $20 fee. I started off with the example that you can probably get rid of really easily with changing to electronic statements. And then you look below. So this is basically the expense ratio. So as I mentioned on the expense ratio tab, it's made up of management fees, 12B1 distribution fees, other expenses. And so all of those accumulated, basically 0.03 plus none plus 0.01 equals 0.04. And as you can see with the investor share class, your expense ratio goes from 0.14 to 0.04. So like I said, the more money you have with them, the less they charge you, which is kind of like an incentive, right? You start with 0.14 and then you drop down to basically 10 basis points, 0.1%, which is very solid. So that's this. I'm going to show you, actually, I'm going to pull this up to help you guys understand kind of how you do this. So can you guys still see my screen like on Google? I just want to make sure before I start talking down. Okay, sweet. Thank you, Tim. Okay, so I'm going to go through that same process. VFX prospectus. Here's the screenshot I took. And then I'm going to go in here. And so this isn't technically the prospectus. I know we Googled that. This is more so the fact sheet. So there's fact sheets and there's prospectuses. The prospectus is the annual report that the fund has to issue the investor each year. So they have to legally send you a prospectus every single year. But if you're just you want the quick, dirty version, you don't have to go through that prospectus. It's kind of long and boring, 50 pages of blah. You can just go to the highlights. So this is the fact sheet. This will tell you everything from here's expense ratio, as you can see right off the bat. That's the biggest one I always talk about. And you can review the fund in general. You can see all sorts of metrics here, what's involved, number of stocks, what sectors they're in, top 10 holdings, all that kind of stuff. But what we're concerned about for this presentation would be the fees. So we see that expense ratio right there. Go to fees and minimums. and this is through Vanguard, so your broker might look slightly different, but it's all the same at the end of the day. And then you can kind of see the total fees. And we're looking at a low cost index fund, hence low cost. I often say is because there's not much of a fee here, 0.04. The average expense ratio for similar funds is 0.89. So again, Vanguard, this is why I recommend them. Stuff like this is they beat the market when it comes to fees, and they are the lowest around. So typically, as you go down here, fund specific fees, purchase fee, there's none. Redemption fee, none. 12B1 fee, which is part of the expense ratio and all that stuff, none. So that's always good. Then you get down here and you see account service fee. So for all accounts outside of the simple IRA, 403, and 401k, there is a $20 annual service fee. That's the one I've been referring to a lot. Here, that's what I was referring to is the fee does not apply if you sign up for account access on Vanguard.com and choose electronic delivery statements. So this is something I caught a couple years ago when I was starting my account, and at this point, probably 10 years ago. And I saw, hey, this is $20 I don't need to be paying. I can just opt out of this simply and not pay $20. Simple IRAs charge a $25 fee for the service fee. 403Bs charge a $60, deducted $5 per month. And then the 401ks charge $20 service fee as well. And so obviously there's some restrictions here. The fee will be waived for participants and all that stuff. And then it says, very put simply, eliminate this fee simply by registering our convenient e-delivery package. You see, I've already selected that at one point in time, which is why it's highlighted. So these are things, guys, that you guys can easily probably get removed. The service fees, especially, but also as you're looking through your investments, let's say you pull up like a actively managed mutual fund, you're going to see a lot different fees here. And let's say it's 0.75 in total. Okay, that's fine. But understand that has to absolutely outperform the index by 0.75 if you're holding that for that specific time. In the short term, that could blow the index out of the water. But if you're a long-term holder, it gets harder and harder with the more time that's there. So that's something to be aware of. Okay, so now that we've talked about fees and we've talked about how to find them, now I want to show you the actual numerical impact that these little guys have that people overwrite and kind of write off. So here's an example. This is actually taken from my book, my Investing 101 book. So total annual investment fees of 0% all the way down to 2%. So remember, we were talking ARC is around in the middle of right here. If you have, let's say, a financial advisor that's also using ARC, you would have, let's say, 1% plus 0.75. So you'd probably be around the range of right here, assuming no other fees were, added to that. So if you had, let's say, 0% fees, you invested $500 monthly for 30 years, your total contributions were $180,000, and you returned 7%. The amount lost to fees was zero, and your account balance would be about $588 after 30 years. Now, as you get down the chain, you can see, let's skip to 1%. 1% accounts for $100,000 in fees specifically. Then you jump to 2%, and that's $180,000 lost to fees. Now, let me phrase this out and kind of put this into perspective. Is like, if you guys have more money invested, more years, more time on your side, and a higher percent return, these only get worse and higher. So that's why I often stress this a lot, because while you might see people getting huge returns with recent trendy investments, most times, if not, they lose to the indexes. And on top of that, they're paying on a net basis, they're losing to the index because they're paying these additional fees. And so it's a complicated way of just saying, hey, I'm going to invest in all these, great actively managed mutual funds to beat the market. But at the end of the day, typically on the long run, they're going to be kind of reduced below or to the net return. So just something to be concerned about going forward as you kind of get into your investment career and kind of look forward. This is another chart. So the long-term effect. So you have $1 million to start with. 7%. The difference is 1.3% on the solid line, and then you have a 2.5% fee for everything on the dotted line. So the difference here is $662,000. Obviously, you're starting with $1 million, so there's clearly a bigger difference. But as I said, in the previous slide, the more money, the bigger this gap becomes. Um, and then so by simply reducing that 1.2%, as it says here, you would save additionally 662,000. Something to be also aware of in the actively managed, I'm not bashing the actively managed mutual funds by any means. So if you have, let's say, 12% into an actively managed fund and you pay 1% and your net returns 11, then you go compare it to the index that returned, let's say 10 during that time, you're still positive. So even if you paid those fees, it still makes sense to technically pay them because you want to focus on that net return. So fees aren't always a bad thing if your net return is better than the alternative, if that makes sense. So that's a lesson on fees. So the other side of things are taxes. So taxes, we want to look at specifically into taxable brokerage accounts. And so I want to explain this a little better is when you look into investment fee or taxes for retirement accounts, 401ks, IRAs, 403bs, they are very tax favorable accounts. So you're not going to see a lot of these taxes in those accounts because of the tax favorable nature of them. The government incentivizes you to put money into those because essentially they take it from us. That's the backstory of it is, those are assets to the government. They have to obviously give it to you when retirement comes, but the more money you put into that retirement fund, their assets and their balance sheet grows. And they're therefore, incentivizing you to do so. So when you put money into like a 401k, you're putting in usually tax or post tax, but you're going to pay tax on either putting it in. So either before your paycheck or after your paycheck, essentially is what that means. And then when you put it in, it's going to grow tax free. And so all of these things that here you see on the screen, capital appreciation, dividends, interest, are going to occur within the retirement accounts, but you're not going to be taxed on those because they're tax favorable. So you eliminate all of that. And then at retirement, depending on which option you chose, Roth or traditional, benefit early, then you're going to have to pay tax at the end. And if you got the tax benefit in the beginning, then you're going to, vice versa. Can everybody still hear me? I want to said my internet was faulty. Just want to make sure you guys can. Okay, sweet. All right. So now we want to get into the taxable brokerage account. So sorry, let's go to the end. So I talked about retirement, so non-retirement. And so this is a lot of times without knowing, when we talk about investment portfolios in the Wealth Squad and we're talking about buying, selling, trading, and all that kind of stuff, most of this is probably happening in a taxable brokerage account. You guys could be trading within a Roth IRA or investing in a Roth IRA, but most times it would probably be a taxable brokerage account. So to be aware of tax implications with those is important. So capital appreciation is a big one. This is the increase in the value of the asset. Your stock price goes up simply. Obviously, you could experience capital depreciation, which would be the decrease in the value, but the capital gains are taxed in two separate ways. So you have short-term and long-term. All that means is a year is basically the marker, so less than a year or greater than a year. Short-term capital gains are taxed at your ordinary income tax rate. Let's say you're at the 22% tax bracket. So your 22% tax bracket is higher than the long-term capital gains, which is 15%. So I want to say there's a technically down here in long term, it's a 0 to 20. Most people are going to hit the 15%. If you are below 40,000, you're going to pay 0% in capital gains. If you are above 440,000, you're going to pay 20%. But so most people are going to fall from 40 to 440 at some point. I'd say the vast majority of us. So that would be 15%. So let's say you got an investment and you held it for 30 years and then sold it. This is the tax implication of capital gains that happened within that investment that you'd be paying 15%. However, if you were in that same investment and sold it within a year, you would be paying the 22%, because you're basically selling way earlier than the government likes you to. And obviously, if you can beat the spreads of the tax and the fees, that's fine. That's a good strategy. It's just unlikely based on historics and statistics. So it's something to be aware of. That's a 7% difference, 22% to 15%. And if you're a higher income tax earner, let's say you're higher than 22%, but you're still within that 440, so you're still paying 15%, that spread gets bigger. So definitely something to be aware of. Another piece of your investments are going to be dividends. So capital appreciation, stock price increasing is great, but you also are going to get dividends. That's a thank you payout from a company. But you have qualified and unqualified dividends. Same thing as above. One is going to be taxed at the capital gains tax rate. The other is going to be taxed at the ordinary income tax rate. And so as you notice, short terms, less favorable, higher tax rate. Unqualified's less favorable, higher tax rate. And then long terms, more favorable, lower, more favorable, qualified, lower tax rate. The reason they do that, guys, it's you got to know the rules of the game, because the government wants their money. And so you have to know their rules. And if you know their rules, you can strategize and play around with numbers, taxes, fees, all that kind of stuff. But knowing these rules are always important. So then you have interest. Let's say you have a bond, fixed income payment from that. Your interest earned is just taxed at ordinary income tax rate on that. High yield savings accounts also will pay you a little bit of interest. That would be taxed at ordinary income tax rate. So that is basically the fees and the taxes in a nutshell. You could go for days talking about fees and taxes, but if at the end of the day, if you listen to this presentation, you will be totally fine from the fees and taxes, how to avoid it. You can talk to CPA and get really, really, really detailed advice on your individual situation. But if you know this, I think you're set, at least for that. But with that being said, I want to open it up to questions. I'm going to look at the chat box. I'll let you guys call out in a second. I know you guys don't want to hear me talking too loud. So, all right. So is there any new fees associated with buying and owning stocks? So individual stocks will not have fees themselves. But at the same time, definitely be aware of the accounts that you purchase through. So if you do have accounts that you're purchasing through, again, we be aware of the brokerage fee, be aware of the account fees. But if you just buy an individual stock like Apple, you're not going to have one associated with that. Can you look up Gush prospectus? Is that a ticker symbol? Is this a mid-cap ETF, or I don't know? What is Gush? ETF snapshot. So here is a snapshot. This is kind of the same thing, but with Fidelity. So this is kind of similar. As you see here, you see some information here. Prospectus, reports, holdings, and index. So you would just open this. You would go here's up here. You can see some more, and then you could probably do. I'm just fees. Here we go. And then you see all the fees are right here. So boom. See how simple that was? It's pretty much just a Google search, control fees. This is I've never even seen this prospectus in my life, but this is where you get it. So here you're paying management fees are 0.5. The expense ratio is 0.8. The reimbursement piece, I guess there's some benefit in number 2 below in this footnote. It probably discusses why there's a reimbursement. The net impact or the net fee is 0.63. So if you think back to that chart I showed in my presentation, let's go here. You're going to fall in the range of like right here, 0.5 to 1%. And so depending on what you invest, returns and all that stuff, this is what you're looking at. Obviously, this is not set in stone, but that's just an idea of where you fall in this range. Let's see. Okay. I'm assuming that's what you wanted me to look up in the Gush prospectus. Oh, sorry, guys. If I lagged out, I don't know which part I missed out on. Not sure why my internet sucks, but hopefully I didn't miss too much.
I'll unmute myself because I was the one who said that. You didn't lie. You only lagged out for maybe 2 sentences. You were fine.
Oh, sweet. Okay.
Um, yeah, it wasn't
Awesome.
too bad. But so my question is so being ambitious as far as like quote unquote beating the market. So I know you mentioned like it's basically like around 10%, 10 to 15% that you're using to beat that.
Hmm.
Um, Speaking specifically on 401ks, you were saying that you didn't really invest in them. I know one caveat is probably if an employer is matching them, we most likely probably do want to match that just to at least get that free money.
Correct.
But between that 401k and whatever we're throwing into our various brokerages, if we're finding that our net account value, given whatever fees that we discussed in this chat, are still breaking plain old 10%, is that just the crux of it, or is there something else that maybe we're not missing, or I'm not seeing?
Yeah, no, that's a good question. So I wouldn't say 10%. The reason I say 10% when I was talking about that was because that's historically the benchmark based on the S&P 500. What I would compare it to would be the total market, or the S&P 500 as a benchmark. So if you have 12% returns, which is technically greater than 10, even net on a net basis, but the S&P is, let's say, at 12 itself, or 13. So you're technically under that. So I'd always benchmark against the S&P 500, not necessarily 10%. 10% is just the historical average of the S&P.
Gotcha, makes perfect sense. Thank you.
Yep. And to clarify the question on the 401ks of not investing. So I invest in my 401k. Mine's through Vanguard. I work for Deloitte, so it's kind of like it's one of the biggest four CPA firms in the world. So therefore, their 401k plan, they can afford to spend money on it. My wife, however, works for a smaller company, and her 401k, her company does not spend a lot of money on her plan. I can tell because it's through Principal, and there's maybe 10 options in the plan. Like it's really bad. So that's why we don't opt to invest into that one. Not saying don't invest into 401ks, but 401ks are known to fee people to death. I think the average person spends $138,000 in 401k fees in their lifetime. So always be aware of the 401k. It's a good avenue, but be careful. For
Appreciate it.
dividend
Thank
tax, go ahead.
My uniform's already in there. Keep that in there. Girl.
All right, I'm gonna mute you guys. Just I don't think somebody's asking me a question there. Just to be safe, if you guys need to come off mute, just let me know. Okay, for dividend taxes, what does qualified, unqualified mean? So there's a certain holding period for the dividends. A lot of times REITs will experience, it's a 60-day holding period. And a lot of times REITs will be the place where you see the unqualified dividends. Typically what you guys are experiencing through dividend investing is going to be qualified. But there are some instances where there's unqualified. They will explicitly have to state unqualified. And it's typically, like I said, you'll see it in REITs. You're not going to typically see that in like a regular company. So that's not something to be too concerned about. But obviously the tax difference could be substantial there. So do some free brokers charge fees without people knowing? Yes, that's a good question. So there's a lot of free brokers out there, right? I think Robinhood might claim they are one. But yeah, they're gonna say, I mean, guys, think about it this way. It's common sense, right? There are a lot of people like the government, for example, when they say they're gonna forgive student loans. Well, somebody at some time is owed that money. It's kind of like fees. They're a business. They have to run, they have to operate. So there's going to be some fees associated with it. Even Vanguard's explicitly states like, hey, here's the fees. They're smaller, they're lower, but there's fees associated with it. It's like anything. Nothing is free ultimately. At the end of the day, somebody's getting paid from some angle. It's just the way they sell it. And so they might say free broker, and they might be referring to the expense ratio as being low, or a specific fee of that is a common fee, like transactions for traders to be free. So there's no transaction fee. So therefore they're a free transaction fee broker. They'll say free broker, and then in like the little tiny an asterisk at the bottom, it might say transaction fee only or something like that. So it's I've never heard of a real free brokers. I'm sure some claim to be, but somebody's paying something because that's how they stay in business. So it's better to put in an ETF than a mutual fund. Not necessarily. So ETFs and index funds typically mirror the index or mirror an index or a sector, and they're typically lower expenses. Um, Mutual funds, technically an index fund is a mutual fund, right? But if you have an actively managed mutual fund where you have like an actual person running the fund, like Kathy Wood, for example, with ARK, you guys, a lot of people talk about, then you're paying a fee. So is it better? I prefer the ETF and index fund, but is it better? Some people would disagree. That's totally fine. I don't have any problem with it. Based on historics, I can tell you this. I can tell you some facts. So from 2000, I'm trying to remember this specifically. 2003 to 2018, Fidelity did a study with basically actively managed mutual funds, large cap specifically, um, mutual funds, actively managed large cap mutual funds. Of the first 10 years, 85% of the actively managed mutual funds lost to the S&P. So only 15% beat the S&P 500 as their benchmark. Another 5 years passed, so 15 years as the time got greater, 92% of actively managed mutual funds lost to the S&P. So 8% of people 8% of actively managed mutual fund, um, large cap funds beat the market. So 8% of is a really small margin. Now, of that 8%, as an investor, how do you know what that 8% is going to be for the next 15 years? And most cases are well, one, we're not going to know. No one knows. We can gamble, we can take a bet, but chances are they're not going to beat it based on historics. Obviously, there's 8% of people that were in those large cap funds that beat the market, and great for them. Like, that's a good thing. I would highly recommend, if you knew that, that's awesome. I just know that it's hard to actually know that. Another thing is, you're talking 15 years. If you bet on a fund for 15 years and it greatly underperforms, well, where does that put you? That puts you way behind, and that could be hard to make up. Whereas if you're just in the index, you know you can guarantee yourself pretty much a good return, because if you're in an index, let's say the total market, you know for a fact the US stock market, the total world stock market, let's say you're in, is going to perform, it's going to go up. And if it doesn't, well, there's bigger concerns at bay than the stock market. So that's kind of my 2 minute spiel on why I prefer them. Not necessarily, they're not necessarily better, just historically speaking. Another thing is, I don't have to be active with it. I like to be passive. I like to focus my attention elsewhere and earning money to put into those investments to make money, versus spend a lot of time actively managing. A lot of you guys are working 9 to 5 jobs, or even jobs that require more time than that. You have kids, you have activities after work. There's things that we can't, not all of us can spend a lot of time on this. So it makes it challenging to understand which ones are the best and to pick those ones. And then 15 years from now or 30 years from now, make sure that those beat them. So it's just not a game for me to play. Another quick study I want to briefly mention is, Fidelity did a study on the best performing investors under their platform were dead people and inactive people. And that tells you a lot, because those people obviously didn't do anything. They just had a fund that was sitting there for years, and they outperformed most people there. So there's countless studies like that. Um, if you buy dividends in a Roth IRA, is it still tax-free while it grows? Yep. So if you buy a dividend or stock index, or let's say a stock that offers a dividend, and they pay out in that Roth IRA, they're tax-free while it grows. Correct. You'll just pay tax on the district or withdrawal, or your money into the account, depending on, well, for Roth IRA specifically, you pay the tax on the way in, so you get the tax benefit later. So when you withdraw, it's tax-free. Are we going to have this class available for review later? Yes, I will. It's recording right now. So we'll get this uploaded to Wealth Squad University. Is Vanguard the better choice for ETFs than a company like T. Rowe Price? Typically, yeah, T. Rowe Price isn't bad. I would prefer Vanguard, Fidelity, Charles Schwab. Those are the top 3 brokers. It's a very competitive market, but as of now, I'd say those three are probably top of mind. And typically they offer better options for investments. If you guys follow me on Instagram, I post often about index funds, low cost index fund options for people. And they're always Vanguard, but you can always search the equivalent of whichever broker you're looking at for those. But yeah, T. Rowe Price, definitely Vanguard's better than them from an all around perspective. How should I check to see what fees my financial advisor is charging to manage my Roth IRA? Just ask him. Ask him straight up. Tell him the truth. And if he can't tell you that, I mean, it should be like on a statement that you signed, a contract that you signed. They're not going to take it directly from the investment account a lot of times, or they do take it a lot of times from the investment account. So you can probably see the impact of that, the net impact within there. But just straight up ask them, because sometimes you see maybe let's say they're charging 1%, but your account balance is small. So one of my friends asked me this, hey, they're only charging me $78 a quarter or something like that. But I was like, well, your account balance isn't as big. So that's as a percentage, that's a pretty large number. So ask them the percentage, ask them to explicitly state every single fee that they charge, the total thing. Don't let them beat around the bush and give you crap, some crap answer. If they can't explicitly state on paper, hey, 1% for this, 0.5% for this, then withdraw that money that day, work with somebody else, but be very careful. Do you recommend investing in individual dividend paying stocks or ETFs index funds? I think this is a great this could be a conversation for days. So I think both options are tremendous. You can't go wrong with either one. So I'm going to start it off by saying that. I am an ETF index fund investor more so. I don't own any specific dividend paying stocks. But I'm not opposed, and I wouldn't say I wouldn't own those in the future. Just currently where I'm sitting at, I'm an index fund investor. There are index funds and ETFs that are high dividend yield specifically for dividends. So one of the good ones is VYM. So I'm going to put that in the chat. VYM is through Vanguard. It's an ETF that's a high dividend yield paying stock. So it's a bunch of high dividends that you're paying out through an index. So it's multiple. You're probably not going to get as high as like, let's say AT&T, which offers 7-8%. J&J, some of those big dividend kings payers that are paying let's say 7 to 10% or something crazy. You might not experience that with the high dividend yield, but you'll still see a high dividend yield nonetheless. But again, yeah, both are awesome options. The power of knowing the rules, knowing the game, is once you know it, you can select your preference. You know which route you're going. You know which taxes you're paying. So having that grasp of the basics, such as this presentation, which touches on the fees and taxes and stuff, what all these different options are available to you, then you can start to game plan, because every investor is different. So my strategy might be different than somebody else. Somebody else might have a lot more. Let's say somebody has 10 hours a day. They're working from home. They don't have any kids. They're very aggressive. They're young. They want to have try to beat the market. Well, maybe selecting stocks or index funds actively managed and trying to beat that spread might make sense to them. They might have time to do all that kind of stuff. And there's nothing wrong with that, but I don't have the time. I don't have the energy to do that. I'm focused on my business, obviously I work a full job. I have a wife and 2 dogs and stuff. And on top of that, we have a kid coming. So in September 8th, there's going to be a new girl in the house. I'll be taking care of her. And I also run BudgetDog, a lot in obviously Wealth Squad. So there's a lot going on. I'm working currently 80 hours a week at my 9 to 5 job, technically 9 to 5, right? But I'm working a ton of hours. So on top of all that stuff, I have too much going on to even worry about all this stuff. And I know with index funds and ETFs, I can just go on with my day and be fine. And I know I'm going to get a good return. I know I'm investing in the right things. I'm not getting high fees and stuff like that. I'm very confident if the market goes down, if the S&P drops, I'm very confident I am not going anywhere. I'm going to continually buy. I'm going to DCA into it. So I'm going to buy more opportunity time, stuff like that. So that's why I personally do it. I like to explicitly state and explain as to why I choose that route, but it's not, there's not a wrong or right or wrong answer. I guess is the best answer. Thanks, guys. Thanks for everybody congratulating. We're expecting September 8th. It's our first one. It's a girl. Erin's 4 months pregnant right now, so should be a fun time. Just broke the news to my parents. Put in for paternity leave for my job and everything, so we're excited. But I want to open it up to you guys to ask any more questions. The chat, I think I got through every question in the chat box. We have 5 more minutes or so. So if anybody else has questions, just shout out.
Hey, you said BYM, right, for the high dividend ETF, right?
Yes.
Okay. Is there any more? Because I'm currently writing them down as you spit them out. I know it's like free game. I was just wondering,
Yeah,
is
yeah,
there any
yeah.
more?
I'm sure there are. That's the one that comes to mind. Let me see real fast. So if I literally type in I mean, you guys obviously could repeat these steps. High dividend yield ETFs. You'll probably see a long list. It depends where you're at and stuff. So here's the VYM I was referring to. NerdWallet has 25 high dividend ETFs and how to invest in them. So as you look through these, here's a huge list of them. I know Fidelity is, I'm going to put this in the chat as well. I'm pretty sure off the top of my head, FDVV. So if you look up VYM equivalent, so a lot of times when I'm searching for like an equivalent, let's say I'm at Fidelity and one of my clients is at Vanguard or something. I'm like VYM Fidelity equivalent. And this is what I've talked about in one of my posts. See how FDVV pops up for Fidelity. So that would be the equivalent there. And here's a long list as well. So there's an endless amount that you guys can look into. That's the coolest thing about these index funds and ETFs and stuff. You can find one for every sector. If you want to find like for example, VGT is a really common one for Vanguard Growth. I think Chris likes that one actually specifically. VGT, healthcare is VHT through Vanguard as well. And so that would be like a sector-based index fund. And you can obviously read up on all of those as well. But there's like just such a wide array of these things. And it's a grouping. You don't have to rely on a specific company, which I, as an investor, have a risk profile of very low. I guess you could say I'm a very conservative investor. So I don't like to put my money, even like an Apple, like to be honest, if I invest in Apple, I'd be fine, obviously. But like, I don't like to rely on any one company. I like to just spread my risk amongst, let's say, thousands and thousands of people. And you can see, like, if I look at let's say, VGT prospectus, and we go to that technically like the fact sheet or something like that. If you look down here and you show, hold on, it's loading. Okay, here we go. Here are all the companies that are involved in that: Apple, Microsoft, Nvidia, and Visa. Then you look at here and you see number of stocks. There's 341 people in that, or companies in that that index fund or ETF, and it's just an easier way for me. The top 10 account for 56%. All of those are very, very reputable companies. I love PayPal personally. I love Nvidia, Apple, Microsoft. You can't go wrong with any of those guys. So I like to just put it all in one. Can you have a 401k and open a Roth IRA, or what would you suggest? Yes, I typically, this is a good, I'll end the presentation on this, guys. This is a great question. So typically I would say yes to both. And what I would do is do 15% of your gross income into retirement. So let's say for ease of math, you have $100,000. 15% in total, $15,000 should be going to retirement. Some in the financial industry will say 10%, but some will say 15, and some will say all the way up to 20%. It's whatever. I think retirement, I think if you start early, you get yourself in a good pace. I think 15% is plenty. I would invest anything above that into like a taxable brokerage account for early retirement. But back to the retirement conversation is step one, I would do a 401k up to the match. And so I would make sure that you are absolutely contributing up to the company match because that's free money. It's a no-brainer. Number two, I would max out the Roth IRA, $6,000 in 2020. And then let's say you have some more money, I would put that back into the 401k. So that would be the 3-step process into plus the 15% in the beginning to understand 401k versus IRA. But both are an awesome option. I have both as well. We have a 401k. Both of us. Well, she does not have a 401k. 401k IRAs. She happens to have like a. I have a pension, and she has a what's it called? ESOP, employee stock ownership plan. And then on top of that, we have a taxable brokerage account as well. And then when our daughter comes, we're gonna open we're gonna basically three-way her for 529 UPMA and a Roth IRA. So there's gonna be a lot more accounts added to the picture when she comes in September. I'll ask this question. 100% Mark. So what percent penny stocks? Penny stocks I do not get involved in, so I'm not the guy to ask for that. I think that answered everybody's question. Does anybody else have like one last question they want to shout out? If not, that's fine. I just want to give you guys the opportunity to ask. Go for it, Aaron. What do you think about DRIV? I honestly don't even know about. I can't speak on it. DRAV is, let's see, it's obviously an ETF of some sort. I've heard a lot of you guys talk about it. It's probably electronic. Is it electronic? Is it a sector ETF or okay, guarantee I know what this is. Okay. Makes sense based on the so here guys, as you see, I'm seeing prospectus and regulatory information. I'm assuming this is a electronic car ETF sector specific thing, is if I were to guess. So if I search fees, let me move this out. Oh. I don't think this is actually this prospectus now. I look at it. Oh yeah, it is. I don't know. It's, oh, here they are. I don't know why it's not finding my control F up here, but anyways, fees and expenses. Okay. So it's gotten 0.68 expense ratio. Obviously this is not the only piece I look at, but when I look at sector specific ETFs, yeah, it's probably because it's a PDF, Tim. I would read this whole prospectus, to be honest, to understand every single aspect of this before I invested in it. So I'm not going to give you a yes or no answer. I would probably lean based on seeing just expense in total generally. No, but again, I would read this whole thing. Like one of the things in my my investing course that I'm going to be releasing is how I actually analyze these stocks in total. And I walked through, I think if you guys were in my last presentation, the 10K, how I break down a 10K. But that's for like individual companies, the annual reports. That's in Wealth Squad University if you guys want that. When I look through this stuff, guys, I analyzed 10 bullet points. So I can't just look at something real fast if I haven't done it yet and do it. But yeah, I mean, it seems like a pretty legit ETF though. I mean, outside of the expense ratio and stuff, I don't know who's all in it and stuff, but let's see. I just finished tax-free wealth, and Tom Wheelwright expressed that he feels that plan, it's like 401ks and IRAs should be used sparingly. And if you plan to retire early, I hope to retire early and have the mindset previous to reading this book. I plan on saving my money and investing it in stuff like real estate and stock market. What's your take on it? I'm not a huge fan of like 401ks in general. So I don't have anything against that, but I will tell you this. No one expects to be 59 and a half or 65 or whatever until they're 65. And all of a sudden life happens and you're 65. And so if you haven't prepared and you haven't planned for that moment, be prepared to deal with the consequence. And so if you don't invest and you're like, hey, screw 401ks, there's a lot of, money Twitter, if you guys are on there, there's a lot of hate on 401ks. It's not my favorite, but I still like them. So if you decide to go the alternative route and invest in real estate, that's totally fine. If you want to do a different route, there is a lot of potential with other things in a 401k. It's not the end all be all. It's kind of like college to me, right? I think college is a tool, but I don't think it's the end all be all. I think it's going to kind of go extinct, or at least it needs a huge revamp. Not to get into too much detail there, but I think that there are multiple tools out there for utilization for us, and if we know everything involved with it, we can make an informed decision on that. But until we do that and understand the ramifications of getting in real estate, and hey, this flipping idea wasn't as fun as I thought, but that passive index investing through my 401k is a lot easier, and I'm guaranteed a pretty solid return type of thing like that. Once you decide, you're going to be fine, for sure. So I'm not going to say I don't think there's anything wrong with it for sure, but just make sure you know if you're not investing into the 401k, IRA, make sure you have other money ready, whether it be real estate investing, taxable brokerage account, etc. Understand the taxes that come with it. There's a lot of benefits of putting some money in a retirement account for tax benefits. Yeah, you can't touch it till 65. No one wants to retire at 65. Our goal is to retire early. My goal is to do the retirement piece for the 65, so I have it there, but also on top of that, cash flow into a taxable brokerage account to early retire. That's my goal. So I can help out with this stuff. If I could do this for my whole life, I would love it. If I could literally just do basically Wealth Squad the rest of my life, I'd be cool with that. But to get out of my 9 to 5 job, it requires other things. So that's kind of my take on that. Emerging psychedelics market. Don't know much about that. I'm sure it's kind of like the cannabis industry. I could see it booming, but I don't know enough about it to really speak on psychedelics. VT wax and chill. Yes, sir. Dividend stocks. When you are paid dividends, how do you separate the different categories, REITs, regulars, and LPs, since they're all taxed differently? When you guys are receiving these dividends and stuff, you don't necessarily have to worry about calculating it. The broker that is you're investing through has to provide that through their tax forms at year end. So if you provide that to a CPA, it will break it out explicitly and show you. All right, so more questions came in. I'm going to let this run for another 7 minutes, go over the time, obviously, but I want to make sure that you guys get your questions answered. So how hard is it to transfer Roth IRA into a real estate investment? Well, your contributions to the Roth after 5 years would be tax-free to withdraw, so you wouldn't have taxes there. Any gains that you would have would be taxed, and there would also be a penalty on top of that. Not tax, but you'd have a penalty, a 10% penalty, which would not be favorable. So I don't know if it would necessarily be hard, but it would cost you some money. I don't know if that would be the best route. I would probably leave it there and then just cash flow and budget for upcoming expense in real estate expense and just do it that way. I just don't trust the 401k. I mean, it depends. I mean, the 401k is just the account. The investments within the account is what you should trust or distrust. And if that 401k has a crappy investment plan like my wife's, like, don't trust it. But the 401k in general is not gonna, it's gonna be there at 59 and a half. Like, I know there's a lot of hate on it, guys, but at the end of the day, it's a good avenue to take. Thoughts on your Roth IRA for rental property? Yeah, that's kind of like the question I just answered. I would not do that. Thanks so much. Why do you dislike 401ks? Came in late. I'm putting money in a HSA and my company offers only a 401k. HSAs are an awesome option. We have HSAs. Well, we both have HSAs. I failed to mention that. That's another alternative for early retirement, for retirement. It's another route through your health savings account if you have a high deductible health plan to save for the HSA. I do that. My wife does that. We aren't going to use it. I do talk on account. I have another presentation. I went into great detail on this, so I'm not going to do too much on this. But as far as the 401ks, why I dislike them, it just depends. 401k to 401k is just so much. They can vary so much. And a lot of times companies go cheap on them, and therefore they have awful investment options, high fees, and they're not really a great investment. And you have other better alternatives than their 401ks. So. Yeah, so the taxes are already taken out by the broker. No. And Aaron, you responded, yeah, they break it up. So on the final tax form that they will provide you, it will break up in categories like that. They have to maintain their investment accounts and understand all the details behind it. Like as my 9 to 5 job, like I'm an auditor, so I specialize in retirement or sorry, in benefit plans. So one of those benefit plans are retirement plans, obviously 401ks. And the brokers, their summary plan sheets are crazy detailed, like by the person, by the category, some totals and everything. So they cover that all for you. I had both a Roth and traditional IRA, not knowing I invested 6,000 on my traditional and 2,000 on my Roth. What's going to happen? Audit. I'm scared. Oh, Claudia, you're probably. I would definitely work with your broker to take that $2,000 out so that you don't go over. You would be taxed or penalized, I guess you could say, on the $2,000 overage. Don't know the exact number that you'd be taxed on or penalized on, but I would work with your broker to reverse that. You have until May 17th to do that, so you should be fine. But yeah, that's never a good thing. But that's, I mean, hey, it's better than not investing. So 8,000, hell yeah, that's awesome. Yeah, Claudia. Also, guys, if anybody has specific questions, I'm gonna get off now. That's probably the last question I'm gonna answer. But if you guys have specific questions, always DM me on Instagram. Always DM me in the Discord and Well Squad. I can't respond with a voice in Discord, so I do prefer to DM in Instagram. So it's a lot more, personal, and I can address your question probably better than a text. But yeah, DM me wherever. Questions in Well Squad, tag me if you guys have questions, whatever you guys need. So always here to help you guys. Thank you, Aaron. Appreciate it, guys. Glad to, as always, I'm grateful to have this opportunity. I love talking with you guys. This is what I'm passionate about. So if I can help you guys in any way, let me know. And other than that, guys, have a good night. I'm going to stop the recording on this so that we have this saved into the Well Squad. So thank you, guys.